performance. Tech stocks extending their slide during yesterday's session, though. Joining us to discuss the move lower and the rotation that appears to be a nascent rotation taking place in the market, Joanne Feeney, partner and portfolio manager at Advisors Capital Management, and Greg Branch, partner at 1847 Financial. Joanne, I said nascent. What have we seen recently in the markets? And is it broadened? Does that make it more sound and feel a little bit less stretched if we see some rotation into some of the laggards? And are we seeing that?
Yeah, good morning, Joe. Good to be with you. You know, we saw this rotation once before in early June. After COVID cases declined, the market really took off, and we saw that spread to other sectors beyond the big tech names. We're seeing some of the same thing here. I think investors are encouraged by the stimulus talks, by the decline in COVID cases. But as you can see, there's still a lot of noise in the market. The sell-off at the end of the day yesterday, particularly in tech names, I think, reflects that broader concern. And don't forget, the whole market has not really gone up as much as that headline number would suggest. High dividend stocks, for example, are down 25%. And when we talk to advisors, their clients are looking for not just growth, but some of them want to lock in some yield so that they can, live off that in their retirement. We like to look for stocks that'll do both, regardless of any sector rotation, because just like in June, this sector rotation, so-called, can back up very quickly, can reverse very quickly. So you look at a name like Broadcom, it gives you both growth and it gives you that yield that a lot of our clients are looking for. So there may be a rotation going on, just like we had in June. It may reverse, just like we had in June. And so what we want to do instead is find the names that will deliver both secular growth, exposed to a lot of these big trends that are going on, like the move to online, like the streaming, and also potentially lock in yield at the same time from a company like Broadcom.
Yeah. All right. So, Greg, just overall, where is the market, the state of the market at this point? If we do see some of the laggards, like the most worrisome sectors that haven't participated instead of the stay-at-home sectors, if they start catching up, does that mean that it's broadening and that this is a real advance that we're seeing? Or do we still just worry about this being Fed orchestrated and sort of, a huge air pocket under the averages?
Right. So to some extent, we've actually seen this movie before. In 2010 to 2012, you saw tech underperform as other sectors in the economy started to recover and bounce off a bottom and demonstrate hyper earnings growth. And I think we're setting up for the same thing again. We talked about this 4 or 5 weeks ago when we were noting the overall disparity of value and growth at near historic levels. Joanne's right. There's been some squiggles in between, but overall, that gap's been widening over the last 18 months to near historic levels. And so the unique thing that you'll have as we get past the election is you'll have sectors that are poised for triple-digit earnings growth, but that are trading at a value price tag. And so when we look at 2021, and overall the whole investment community will start to do that after the election, you have consumer discretionaries expected to grow at 100%. You have financials expected to grow at 50%, yet trading at half their normal average at 1.1 times price to book. You'll have utilities growing at over 100% and energy growing at 600%. And so I think we're setting up for something that we saw similar to 2010 to 2012, where the S&P 500 X the tech names is going to grow at 35% versus the tech names growing at 15%. And investors have started to wonder, will those names have the growth to support those outsized multiples?